This is the Real Estate Investing Abundance Podcast. I'm your host, Dr. Allen. I know you're excited to get into today's show, but I have a very exciting announcement to share with you before moving to the show. We've just launched a complimentary and comprehensive webinar that, among other things, shows you how to legally use passive real estate investing to reduce your taxes, recession-proof your nest egg, and take the sting out of inflation. If you are curious to learn more, go to stevetucker.com/webinar. It is complimentary and only takes a couple of minutes of your time. Once again, that is stevetucker.com/webinar. I'll see you in the webinar. Enjoy today's show. Hello, enlightened investors. Welcome back again to Real Estate Investing Abundance. As always, I'm so delighted you have elected to be with us today. We have an excellent show today. We are going to take a look at making sense of an uncertain market. And with us today is Andrew Cushman, who has successfully syndicated and repositioned over 2,700 multifamily units. Outside of the business world, Andrew enjoys surfing, backcountry skiing, and trying to not be outwitted by his two young children, which I suspect he fails at consistently.
Yes, regularly.
So Andrew,
they change the rules every week.
So Andrew, take us into the show and share an experience that was key to helping you be who you are today.
You know, I would actually, it's an experience that was repeated over and over again, actually. And it's funny, we kind of actually touched on this pre-recording, and that is growing up, we moved a lot. I think the longest we ever lived in one place was 5 years. Now, that's nothing compared to some military families that move like every 9 months. But, you know, every 2 to 5 years, I was changing states, changing school systems, often across the country. We went from New England to Texas, which you might as well move to a foreign country, and then back. And then, you know, like I said, I was constantly going into new schools and all that. And while that was definitely a difficult thing to do and to do over and over again, I think the most challenging one was I had just started high school in New England, and then we just moved to Texas midway through freshman year, right? So I show up, I'm a Yankee, and everyone already had all their friends and like, hey, here's this new guy. But what those experiences taught me or helped build, I think, was resilience and adaptability. The ability to just walk into a new and uncertain environment and figure it out and thrive. So definitely difficult each time, but it because of it, I think I learned a lot of skills that have helped me very much as an adult.
Well, definitely good skills to have, and for sure, as an adult, we need to be able to adapt, and certainly we are facing some uncertain times. And so let us take a look here at what does that mean for the passive investor in real estate. So if you could just start off, Andrew, by just actually giving us a definition of what passive investing is as compared to what an active investor would be in real estate.
Passive investing means effectively that you're not the one doing the work, that the returns on that passive investment show up in your bank account, whether you're working your job, running your business, or spending 3 months in Cabo. That's a passive investment. Whereas an active investment is, we're talking about real estate. So, a passive investment in real estate would be like, hey, I'm going to invest $100,000 with this, sponsor that's buying a multifamily building, and there's going to be 25 other investors, and it's that company's responsibility to find the deal, to acquire it, to operate it, to sell it, to send out the tax forms, all that stuff. And as a passive investor, your only job is to read the reports and stay informed and collect the money. An active investor is someone who's doing that on their own. Whether they're doing it as a business to try to bring in other investors, or just for your own portfolio. But that means that you have to have the ability, time, and expertise to go out and find the deals, acquire them, operate them, and sell them, finance them, and all of those things. So that's the difference between passive and active.
Well, thank you for that explanation. A lot of people are confused about that. They are watching these shows on TVs where they're seeing all of these flippers and rehabbers, and a lot of people think that that's what real estate investing is. It's probably the most difficult way to get into real estate investing, and many people start that way. And after a few years of that, they find out this is not what I thought it would be. But you don't have to start there. You can start as a passive investor. So, what are some of the major concerns that a passive investor should be concerned with, particularly in these uncertain times that we're facing today?
We could spend an entire day talking about all of those, but there's a handful of, either I would call it either red flags or things to evaluate whether you're, and this really, of course, I'm coming from a multifamily background, but this really applies to any kind of passive or limited partner investment, whether it's industrial or self-storage or anything like that. Number one, especially where we are in today's, like you said, Alan, uncertain environment, ideally you're investing with someone who's been in an uncertain environment before. The last 10 years were pretty easy bull market. If you just bought something decent and did an okay job operating it and held on long enough, the odds are you made money. Those days are over. You can still make money investing in real estate, but it's like when you if you ever notice when you get off a plane at the airport and you get to the spot where there's an escalator and there's stairs, and the stairs are completely empty and there's 120 people on the escalator. The last 10 years were the escalator. Now we're at the stairs. So you can still get to the top, but it's going to take effort and execution. So in an uncertain environment, try to invest with somebody who's been through an uncertain environment before. Again, the next thing is regardless of the asset class, stay away from investments that are highly leveraged. And what I mean by that is if the investment is a total of 10 million, and they're getting a loan of 8 or 9 million, that's very highly leveraged. There's not going to be a whole lot of cash flow there to pay that mortgage, and there's going to be very little cushion if something goes wrong to keep your equity from disappearing. Low leverage or conservative leverage is typically 50 to maybe 65%. Make sure that if you're looking to invest passively, that whoever you're investing with has multiple exit plans set up for multiple situations. What happens if interest rates rise? What happens if they fall? Everyone's hoping they fall because everyone says, oh, that's going to be great. And on balance, it is. But if you fix a loan at today's interest rates and then rates drop a whole bunch and you go to sell the property and pay off that loan, the prepayment penalty could end up being 20 or 30% of the loan balance. That's a huge hit and it would suck the profitability out of a deal. So you've got leverage. We talked about the leverage, and then all other things too is always check track record, right? Almost nobody's perfect, and pro forma, nobody will ever hit a pro forma exactly because it's a prediction, usually 5 years into the future. So you're never going to hit it exactly, but you're always going to end up above or below. But you want to invest with somebody who, on balance, has a long track record of hitting their projections. And again, that doesn't mean that they're going to have been perfect. And that's a question you should ask: is, hey, what's the worst deal you've ever done? Have you ever lost money? Have you done a capital call? What has gone wrong, and how did you adapt to that? Right. So those are three things that come to mind right off the bat. So I don't know. I know we don't have all day, so I'll stop there. And then Alan, if there's any more you want me to add, or if you want to follow up on any of those, I'm all for it.
I think those are a good recap of that. That was four things: know your sponsor, lower the leverage and multiple exit plans, and know the track record of who it is that you're investing with. Good suggestions there. And I think if you hit those four components there, you can rest. I don't know, you can be pretty well assured that you're placing your money with a worthwhile investment that will most likely give you some very decent returns. Well, you had just briefly mentioned, you had gone over the various different sectors of real estate, from multifamily to industrial, to retail, and so on and so forth. So could you give us a bit more of some definitions as to what these different sectors are and how it is that they differ in terms of an investment from a passive investor's perspective?
Well, I mean, my expertise, of course, is multifamily, but, so I'll start. So, I mean, there's tons of niches and specialties, senior housing and car washes and, industrial sites. There's retail, which is, like physical stores that you go and consumers go into buy stuff. Self-storage, which, is exactly what it sounds like. Yep, don't have enough space in my house for all my junk. I'm going to go rent a spot and store it there. You've got multifamily. I've seen people specialize in ATMs and marinas. And so any of these different niches will react differently in different economic situations. Some are recession resistant, some are more cyclical. And that's something to evaluate if you're looking at those investments. It is wise to diversify a little bit. For example, sometimes we'll have people come to us and be like, hey, we have this, large amount of money. What do you recommend? Do you have any investments and what do you recommend we do with it? And we'll say, well, yes, we should hopefully have something soon, but regardless, you should diversify a little bit with different asset classes, different operators. One of the reasons we are, or multifamily is one of our favorites, is because nothing isn't recession proof, but multifamily tends to be pretty recession resilient. People have to have somewhere to live, generally speaking. Obviously, we have a homeless issue, but with that aside, people will do everything they can to keep a roof over their head. And we have, unfortunately, a significant long-term shortage of housing in the United States. And in a recession, especially if you're in the kind of the middle market of rentals or apartments, meaning not the super high-end expensive stuff, but not the really low-end stuff, but the middle that is affordable to the broadest swath of the population, again, operations may decline a little bit in a recession, but you're still going to have a basically full building if you're operating it right. You can lower rents if you need to keep it full. And again, if you bought it right and you financed it right, yeah, your cash flow might temporarily drop, but you're not going to be in trouble. You're still going to be able to pay the mortgage, and you're still going to hopefully build reserves. And one of the beautiful things about real estate in the United States for the last 100+ years is time is actually on your side. As long as you can hold long enough, you're going to be able to sell that property for more down the road. Right now, if you bought in a bad neighborhood in Detroit 50 years ago, maybe not. But that gets back to market selection, right? Buying in the right areas. So yeah, those are just some of the niches and the classes. Again, there's some of them are doing great right now, and I would never tell anyone, oh, only do multifamily, don't do industrial or any of that stuff. But again, we really like multifamily because of the short leases. You can adapt very quickly to the changing environment. There's always demand. And if you hold long enough and you, again, put the proper financing on everything, you can almost always be guaranteed a favorable exit as long as you can wait.
Exactly. And multifamily, I mean, you were talking about it being recession resistant. Even in 2008, if I recall correctly, I mean, vacancies, of course, increased and rents declined, but I don't think overall average over the United States, I don't think vacancies on the average ever dropped below 90%, or I mean 10% vacancy rates. And the decline in rents probably didn't go below 10% either.
No, you're
don't
correct.
imagine.
The numbers that I have heard repeatedly is that the worst year of rent growth was -9%. So it fell 9%. And that's significant, but like take where we are now, rents are up 20 to 30% over the last 3, 4, 5 years. But if they come back down 9%, it's not a big deal. We're just reverting to the mean, and actually it would be healthy. It is not good to have 10, 15% rent growth because it creates an affordability issue and it's not sustainable. So, I don't think rents are coming down 9% in the next year, but if they did, all of our properties would still be in great shape because the rents have already gone up so much. So it sounds scary, but in reality, if you kind of zoom out a little bit, it's not. And then also in terms of, we touched on a minute ago, the uncertainty in today's market. When we had the great financial crisis, we went into that with multifamily already being in a weak position. Because if you remember, you could get a mortgage if you could breathe, you could get a mortgage. You didn't even have to have legible, you could put an X on the signature line and get a mortgage. So everyone who had any inclination of owning a house was moving out of their apartment and buying a house. And so the years leading up to the great financial crisis were actually really difficult in multifamily in terms of keeping up occupancy and finding quality tenants. So then when the recession hit and liquidity dried up and everything else, seized up, that's why you saw rents come down 9%. That's why you saw vacancy go up. And that's why you saw some good deals for a few years, is because multifamily was really weak to begin with and then got slammed with a recession. This time around, we have a recession that is basically being caused by the Fed tightening, right? Everything else is actually too strong, right? That's why they're tightening. And with multifamily, occupancy is very high. Collections are at near all-time records. Demand is still very high and liquidity is still there. You might pay a higher interest rate than you would have 12 months ago, but you can still get a loan. And in 2010 and 11, you couldn't get a loan, period, almost, right? So there's definitely uncertainty right now, but it's vastly different than last time. And so that's why we're actually pretty excited at the chance to, I think, get some good opportunities for the next 2 years, but not see kind of a general industry-wide disaster like we saw last time.
Enlightened investors, if you haven't done so already, be sure and click that like button and also click that share so others can take advantage of the content. And finally, be sure to subscribe so you don't miss a single one of our upcoming episodes. Well, and talking about recessions, I mean, the point that you were making about low leverage, that's what is going to save an operator.
Yes.
In times of recession. Because if you're leveraging at 50 to 65%, like you suggest there, you can handle a 9% decrease in rents and a 9% vacancy rate. If you're leveraged at 75 to 85%, you're going to be challenged with those kinds of declines. So leverage is so important to that equation. A lot of successful professionals have what are considered sometimes gold-plated retirement opportunities from their company, and then they also probably have 401ks and IRAs on the side of that. What about that is problematic from your perspective as a real estate investor?
I mean, problematic in terms of investing, just having one, or only solely investing with that way, or?
Yes, solely relying upon your company retirement plan and your 401k or IRAs.
Well, one of the challenges with doing that is all of your eggs are in one basket and it's somebody else's basket, right? So like one of the things Warren Buffett says is, yeah, put all your eggs in one basket, but watch that basket really closely. When you're counting on one company to fund your retirement or to provide your retirement, what happens if that company goes bankrupt? What happens if that company didn't fund the pension plan like they were supposed to, or what they invested in drops 20%? What if they invested in bonds and now they're almost illiquid? So I do think that having a 401k and similar type vehicles are a good thing to have, and they're basically like one leg of the stool. You should have that. Yes, invest some in stocks. Stocks can go up 20% for 6 months and then in 1 week drop 20%. So just be prepared for that volatility. And then, as people age and get closer to retirement, that stock portfolio becomes more risky, because if you're planning on taking out money next year and then all of a sudden things drop by 30%, you have an issue. One way around, and then also typically those 401ks and those type of plans highly restrict what you're allowed to invest in. I know I actually still have one from when I used to be an engineer 15 years ago, and there's 5 things I can invest in, like 5 mutual funds. That's it. And it's like, well, okay, how much real choice is there? The alternative to that is, or maybe I would say in addition to that, is self-directed individual retirement accounts. And what that, and that's generally not with your company. That's with a third party custodian like a Pacific Premier Trust or N Trust or there's tons of them, where you set up a retirement account. It can be Roth, it can be, all the different variations, but you are allowed to invest in basically anything except art and collectibles. So you can invest in precious metals. You can invest passively in real estate. If you have, $200,000 in a self-directed IRA, you can make four $50,000 investments in different, as a passive investor, in different real estate deals. So the 401k is a good start, but there's there's a lot more that can be added on to that.
And you don't have to set up a new IRA or a new 401k. You can roll those accounts over into that self-directed account.
Good point. Yes.
Of course, the 401k, if it's with your current employer, you're probably not going to be able to do that. They won't allow you to do that in most cases. But if it's a 401k from a previous employer, you have more control over that. So all financial advisors are going to tell you to do what you just did, and that is to diversify. But most financial advisors that you go to, they're going to tell you to put your money into Wall Street. And then they call diversification what you just mentioned. There's 4 or 5 different options you have, and that's your diversification. So how can you use real estate to actually really to fully diversify a portfolio?
Well, yeah. I mean, you're 100% right. They call it diversification, but it's not. If you're buying 10 stocks, you're in one asset class. You're just in stocks, and then half the time, I've met people like, "Hey, I bought 10 tech stocks." Well, not only are you not diversify, you're like really, really narrow, right? And that might do great one year, and then the next year it all goes away. So yeah, so how you diversify is by creating those accounts, and where you can put money in different forms of real estate. And again, and it can, once you have that, you can do industrial, you can do multifamily, you can do self-storage, and each one of those behaves a little bit differently in different economic environments. And so what that helps prevent is, if the stock market crashes, that doesn't, your real estate is probably still going to be holding its value. And even better, one of the two of the benefits that real estate provides that stocks typically don't are cash flow and depreciation. Now, some stocks do send dividends, maybe 1% or 2%, but well-run real estate can distribute, upwards of, 5, 10, sometimes 20% cash on cash annually, and depreciation. And so we'll, say, okay, hold on, Andrew, what's this depreciation business? Well, what that is like, let's say, for example, we buy a $10 million building. The IRS lets us do what's called a cost segregation study. And they let us bring in a professional accounting firm. They say, okay, we bought this, but the lifespan of this refrigerator is 5 years. So the value of this refrigerator is going to be 0 in 5 years. And what they do is they take all those components and they separate it out. That's why it's called cost segregation. And they depreciate it. And so what that means is, even though you still have that refrigerator, on your taxes, you can say, well, the value of it declined $200 this year. And you get to put that as a $200 loss on your income statement. And then at the end of the year, investors get a K-1, which is just a tax form that tells how the investment performed. Well, that depreciation gets passed on to the investors. So you might have gotten, $10,000 in income from your passive real estate investment that year, but you might get $12,000 in depreciation. So what does that mean? That means you pay 0 income tax on the income that you received from that investment. Now, when it gets sold down the end, you might have a little bit of recapture, and you might have some tax to pay, but it's also typically at a lower rate. And would you rather pay the government today or 5 years from now? Right. So that's one of the advantages that stocks and some other things don't have. And again, without getting complicated, there's even more sophisticated ways that you can try to make sure you defer that tax, even longer. But you can't do that with stocks.
Right. And this surprises a lot of people. I mean, a lot of people were shocked when Trump finally revealed his tax returns, and he wasn't paying any taxes. But to real estate investors, not too many of them were surprised because that's just typical. And it's the big secret that really, I think, builds wealth beyond what any other investment can do, is because Congress loves real estate investing, and they've written the tax code to favor that.
Yeah.
Andrew, we're getting close to running out of time here. So tell us about your company and how our investors can get in touch with you to take advantage of the offerings that you have there.
Yeah, we're Vantage Point Acquisitions. We buy kind of B class, middle of the road workforce housing in the Southeast United States, Florida, Georgia, and the Carolinas, and Eastern Tennessee. We typically hold for about 5 years, and we do value add. So we're usually aiming for a blend of immediate cash flow and then also long-term wealth and equity creation. If you want to find out more about us, the website is exists Vantage Point Acquisitions. If you Google that, we'll come up. I've been told I have really good SEO. I can't take credit for that. It just kind of seemed like it happened. But the website is vpacq.com. There's a couple of tabs on there that allow people to reach out to us and connect with us. Also, please reach out on LinkedIn and connect there. I am kind of old school. I'm not a big social media guy, but I do like LinkedIn, and I'm working on posting and engaging with people a lot more there. So if you'd like to do that, please connect with us there.
Well, Andrew, let's just go into our last set of questions, the meaning of life questions here. And so, what is one of your most difficult setbacks, and how did you come through that? And what did you learn from that?
There's a handful. On the personal side, 2 weeks before starting college, I had one of my fingers cut off in a restaurant accident. So that helped build some resilience and reframing. But actually, now that I say that, actually, I want to skip that and go to a real estate example. And I mentioned earlier, you should always ask, hey, what's your worst deal? So the worst syndication we ever did was 10 years ago when we were kind of getting started. We bought a large 350 unit, very rough property in a very rough part of Dallas. And we underestimated how rough the area was. I mean, it was just tons of crime and violence and all that. It was an old building. It had been neglected for a long time. So we underestimated how much the renovations were going to cost. And, what we found is those old rough properties look great on a spreadsheet, but in real life execution, it's totally different. So rather than hold it 5 years, it was 2015. I don't know if you remember, Alan, but everyone thought a recession was coming in 2016, right? So we said, hey, we don't want to be holding this kind of property in a recession. These kind of properties don't do well in a recession. So we just pivoted. We sold it early. We got everybody's capital back plus a small single-digit return. Obviously not what we were hoping for, but number one rule is never lose money. So that's what we told our investors. We said, look, this is not what we thought it was going to be. We're going to sell now. We have a good offer on the table to make sure that we don't lose money. And we're going to, cut this one short and move on to greener pastures. And that experience informed a lot of what we do now. We have a very strict and extensive screening process to make sure that we don't buy in areas with high crime. We don't buy in areas with low income. We don't buy in areas with, population decline. We also don't buy old properties anymore. We buy newer stuff, kind of middle of the road. And like I said, there's a whole lot of things that we learned and pivoted from that. But that was a rough 2 years. And I know whenever the caller ID showed me someone from that property was calling, I was just like, oh man, what is it now? So we pulled it out okay, but that's part of why I'm half gray now. So.
Well, I think that's a good reason not to invest with investors who haven't been through those kinds of experiences, because they are very painful, but they're very, very educational.
Very educational.
So, what are 3 good things that have occurred to you in the last 24 hours?
In the last 24 hours, well, let's see. I woke up healthy and rested this morning. We have a giant fluffy cat that my wife actually potty trained. And this morning when I got out of bed to go to the bathroom, he rushed in the bathroom and likes to try to cut in front of me. He jumps up on the toilet and he uses it. And it just makes me smile, like this big, fluffy, cuddly cat using the toilet like a human. you know what? It's silly, it's inconsequential, but every time he does it, it just makes me smile. And so, you know what? I count that as a good thing. And then, you know what? I had a physical therapy appointment this morning to work on a muscle that I strained a couple months ago. And well, that's not a fun thing necessarily go to. I'm thankful and appreciative that I have the time and the finances and the ability to get good care, and that I live in a country where that's available. So.
Well, how are you putting your successes as an investor and entrepreneur to work to create universal well-being?
So one of the things that we do is it almost sounds cliche these days, but we really do try to form good create good communities with the properties that we buy. And I'll give an example. This was yesterday I found this out. So we bought two properties in the city of Grovetown, which is outside of Augusta, Georgia. And we've owned those 5 or 6 years now. And they weren't bad when we bought them because by that point we'd stopped buying bad stuff, but they still needed some improvement. And the police department stopped by our leasing office yesterday, and all they wanted to do was to thank our property management team for running those two properties so well, and that how much they appreciate that they don't have to go out all the time for calls anymore, and that the crime and everything is way down. So improving communities really helps. And kind of along those lines, one time I was walking through one of our assets and this lady comes running out and she's like, "Are you the owner? Are you the owner?" And of course you never say, "Yeah, I'm the owner," because I mean our investors are the real owners. But I said, "Well, I work for the owners, right?" So that's what I tell, which is true. I work for the investors. And she goes, "Oh, give me a high five." I'm like, "Okay, cool. This is going in a good direction." And then so I high five her. She's like, "Next time you're out here, let me know. My husband and I are going to make you barbecue because this place is finally a safe place to live. And we really appreciate all you guys have done to clean it up and to improve it." So, that's part of creating kind of universal well-being. Also treating our team members and our staff and all that with respect and an attitude of trying to serve them goes a long way too.
And our last question, imagine you've come to the end of your life and you lay on your deathbed. What do you look back on with your greatest sense of joy and fulfillment?
I think that would be a number of things. Hopefully as a Christian, I, followed followed Christ well. Definitely fall short of that on a regular basis. Two, I would hope that I look back and feel like I dedicated the time and energy and resources to my family and to relationships. And then hopefully I enriched lives as long as I went. And whether I die tomorrow or 50 years from now, my goal is to feel like I did everything that I could in the time I was given, which includes all those things that I just mentioned, but also, I love, as you mentioned in the beginning, backcountry skiing and surfing and, and mountain climbing and all those things. And, just feeling like I did, as much of all that. You never know how many days you've got. And I'm going to do everything I can to make it another 50 or so, but whenever that is, those are some of the things they'll be looking back on.
Andrew, wonderful having you today. Thanks for being on the show.
It's good talking with you, Alan. Take care.
Enlightened investors, wait, don't go just yet. I just want to remind you about our recently launched webinar that you will not want to miss. If you're at all curious and would like to learn more about how real estate investing can diversify your investment portfolio, alleviate the anxiety associated with Wall Street swings, leverage your 401ks and IRAs to substantially increase the return on your investment, and do all of this with turnkey, hands-off, passive real estate investments, then you'll want to immediately go to stevetalker.com/webinar. In the webinar, we'll also address the common dubious investment schemes that you want to avoid. To access the webinar, go to stevetalker.com/webinar. I look forward to seeing you in the webinar.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.